There's currently a lot of drama out there right now with Trump and with Jerome Powell and what he can or can't do and what would really happen. Now, we all know that Powell is the Fed chair, we know Trump is the president, and we know that Trump has been saying a few things lately to kind of indicate that he may want to remove him from power if he can, right? So we're going to talk about in this video if he can, what scenario he can do it, and then ultimately the effect, meaning not necessarily the effect of him being removed, but the effect in the case of if interest rates are cut too quickly. And what I mean by that is, assuming the reason why Trump wants to remove Powell is due to the fact that he's not cutting rates fast enough, which he said publicly on his Truth Social account, he would implement someone who may cut 1 whole percentage point right away, right? And that's drastic, don't get me wrong. But I want to talk about what can happen in the scenario if rates are cut too quickly. So if Trump does get rid of Powell and puts in someone else, which is going to be someone who would want to cut rates quicker, I'm assuming, because that's who Trump would appoint, theoretically, that would align with his viewpoints, what the effect on the economy and the market could be. So real quick, let's start with, can Trump even do that? Can Trump remove Jerome Powell? Well, there's only 3 technical ways that a Fed chair can be removed. And the way the Fed's designed is intentionally like how our branches of government, to have separation of powers, right? We don't necessarily want one person having full control over different arms of the government because that makes it ungovernable, or it makes it a tyranny, right? Some sort of dictatorship. So there are 3 scenarios in which a Fed chair is removed or changed. First one, the obvious one, the term expires. So if their term expires, they're no longer part of the board, they're no longer the Fed chair. Simple. Fed Chair Jerome Powell's term expires in May 2026, so it's not even that long of a wait. And at that point in time, Trump can nominate someone else too, but that may not be quick enough. So the second reason why you could have a new Fed chair is if they die or resign, which can roll into being pressured by the president or pressured by other political party members to tell them to resign. That's the obvious second option. The third option, the most controversial option, is called removal for cause. Now, technically, the Fed chair can be removed by the president for cause, meaning the president would have to cite one of 3 reasons of the cause being either misconduct, dereliction of duty, or ethical or legal violations. So that can be spun any which way you'd want it to spin if you were someone who's trying to get rid of Powell and if you didn't agree with what he was doing, whatever, right? Now, this technicality has actually never been used in the history of the United States government. And to be very clear, policy disagreements in general, so if Trump says, lower it by 1%, and Powell says, no, that's dumb, that disagreement is not grounds for removal. So in the same reason why you could get fired from your job by having some ancillary reason like that you shouldn't be fired for, race, creed, religion, if you're pregnant, whatever, those are reasons you shouldn't be fired from your job. But let's just say you didn't mop the floor right or something. They can go, you didn't mop the floor right. That's why I'm firing you. Even though it really is those other reasons they can't legally fire you for, they're going to find reason to fire you for that. And that is where Trump can actually legally remove Powell. Now, again, to reiterate, no Fed chair in the history of the United States government has ever been forcibly removed. So doing this, because it's such a gray area, could spark a huge crisis, constitutionally speaking, over the Fed's independence versus the other branches of government, right? That is a fantastical, horrible thing in general if you're a trader, because that is the top tier of uncertainty, right? Anytime markets are uncertain, we don't like that. It makes it very hard to trade, and people get a little scared. Having Powell removed for any reason, right, could spook the market either which way, which is a very scary thing to think about because we don't know what happens and what could happen and what the bang-on effect is for other companies and the economy as a whole. Speaking about the economy, now let's just pretend that does happen. Now, and we'll ignore the fact that let's say it happens, and then let's pretend the market does nothing. Let's pretend there's no effect on the economy immediately, right? What would happen then if Trump actually institutes a new Fed chair, and let's play with the thought that the new Fed chair wants to cut rates immediately at 1%, because Trump has said the Fed's too high, cut rates immediately, cut it by a whole percent, etc. And those could be dramatized, of course, but in the event that an aggressive cut, and to be very clear for those who don't know, a cut is typically about 25 basis points each month when they were in a rising or falling rate environment, typically 25 cents, sometimes 50 basis points. So 100 would be a big deal very quickly, especially when we've gone from a raising rate environment to basically stagnation where we're not raising or dropping, nothing's happening. A quick drop could spark a few different catalysts, and I have them all here for you right now. What you want to watch out for the very first thing is a sharp drop in interest rates could actually reignite inflation. So think of it this way. If there are rapid rate cuts, it could increase liquidity in general, which increases borrowing, which can boost demand way too quickly, right? Because the whole point of the Fed is to balance supply and demand, essentially. So if inflation hasn't been fully tamed yet, which the CPI report is hinting we're kind of trying to get there, that can reignite price pressure and consequently undo the previous progress on reducing inflation. So if we cut rates too aggressively while CPI is relatively elevated, it could actually really destabilize consumer expectations, which could then push inflation even higher. Now, the bang-on effect of that is we could actually weaken the currency. So for you as an investor, if you have money in the stock market, that might be great because equity is going to do this. The dollar goes down, people look at equity as an opportunity or at least a hedge for against inflation and a bunch of other reasons why you'd move to equity with a lower dollar or weaker dollar, which is what would happen to the market. The market should theoretically go up. It's the same reason why when the Fed starts to cut rates, we see a big pop in the market. It's also the same reason why, what I'm going to talk about here momentarily, the same reason why we see eventually a bear market happen after that in the near future. And if you don't believe me, feel free to look it up. So these lower interest rates could reduce the demand for currency, theoretically. As a result, that can lead to a weaker demand for the US dollar, which could actually increase the cost of imports, which would ultimately fuel inflation through higher input prices. So not only do we have the tariff drama, but then a weaker currency could really mess up the economy from that point of view, if that makes sense. Now, these two things that I previously alluded to can cause a bubble. So we could see markets interpret fast cuts essentially as a green light to go super ultra risk on. Like all the way, stocks, crypto, real estate, everything. And that can cause a massive asset bubble a la 2008, a la the dot-com bubble, right? Because risk and reward are completely mismatched, right? And we talked about the Fed's importance is balancing supply and demand. So when there's that mismatch, speculation increases wildly. A lot of meme stocks, story stocks, junk bonds thrive theoretically because these companies that have a hard time surviving have now an easier time surviving. Borrowing money's cheaper. So these companies that can come out of the woodwork, like a Nikola, right? Like even a scam company, right? Can sell you a story and they can borrow money easier from an investment firm or something like that because money's cheaper to borrow. So yeah, come to me. I'm a venture capitalist, and oh yeah, money. It's the interest rate's so much lower now. Yeah, I have $5 billion, whatever. So because of that understanding of risk being so much lower because money just happens to be cheaper, that can cause overestimation of risk assets. So we get a big bubble, and eventually bubbles, what do? They burst. So you can ride the wave, right? But the other thing you want to think about is how long to ride the wave for, obviously. Let's pretend the SPY is trading at $500 right now. And let's pretend interest rates are dropped by 1%, theoretically, right? And we'll say 1%. You put all your money in that $500 SPY, and SPY goes from $500 to $1,000, and at the same time, interest rates are dropping. Well, inflation's going up. So if you can't outrun inflation, even though you made 100% gain on your money, again, in theory, if you can't outrun inflation, this is a big example, if you can't outrun that inflation via equity, then you might even just break even. So yes, on paper, you may see that you made a 100% gain on SPY from $500 to $1,000, but if inflation's rising just as aggressively, all you did was break even because your buying power, right, what your dollar can do for you, essentially stays the same, which doesn't you no good. Now, it's better than losing money with sitting in the bank and getting rusted by inflation. But these are the things you want to keep in mind as you potentially enter this risk environment. Lastly, I have two more things here. There could be financial instability. So banks, how they make their money, or what a big portion of how they make their money, they rely on interest income to make their money. So net interest margin, essentially. So if rates drop too quickly, then their profit margins, what are they going to do? They're going to shrink, right? Because the way that they set the rates up, they leave a little headroom there. So if the prime rate right now is 4.5%, a mortgage right now is 7%, the bank makes the difference of the 4.5 to 7, theoretically, right? Or whatever other ancillary percentages and fees, whatever that are in there, they're pricing it higher so they can make a profit, obviously. So if banks are holding longer term assets like bonds and the rate drops too aggressively, this could really pinch banks pretty hard. So in extreme circumstances, you could see some credit tightening or bank runs if the confidence in the market in general is shaking. Which, again, that's an extreme case. That's like Great Depression kind of thing. I don't think that's going to happen. Let me make that abundantly clear. But it doesn't excuse it from the possibility of it happening if rates drop too quickly, to be very clear. Lastly, and I think this is actually the most important part, the loss of credibility. So this is something that isn't tangible, so to speak, but if the Fed cuts rates too quickly and they have to raise them later, it doesn't look like it is strategic, I guess you could say, but it looks more reactive. So essentially, markets would stop believing the forward guidance from the Fed or Fed projections, and consequently, I want to say they could kind of ignore it, right? Which could, again, makes the risk to reward completely out of whack, which causes more volatility in their policy, which can make businesses ultimately more hesitant to invest or hire. There are very few scenarios, I would argue, where a quote unquote fast cut could be quantifiably acceptable, and that would be in like a severe economic scenario. I guess you could say like a financial crisis, if there's a super huge major deflationary threat, or unemployment rises dramatically a la COVID, right? Something happens dramatically. If the credit market freeze, or like geopolitical emergencies would warrant a fast cut, because those are the scenarios that there is a justification for said action to occur. When there isn't a justification and you just want to cut by a percent wildly, everything I just said prior more than likely is going to be what's going to happen. So these are the things you want to keep in mind if you are watching the market and if you're watching the drama that's going on right now between Powell and Trump. And if something does happen, at least now you're prepared to know what would happen if the market did cut rates, or I should say if the Fed cut rates very aggressively, and how it could affect the market and, more importantly, your wallet personally.